Welcome to the Deep Dive, where we cut through the noise and get you straight to the insights.
Yeah.
Have you ever looked at a company and just wondered how it keeps delivering, year after year, through all the ups and downs? We're talking businesses that reward shareholders consistently, decade after decade. Well, today we're taking a deep dive into a pretty special class of companies, the Dividend Champions.
Yeah, and what's really remarkable, I think, is the definition itself. A dividend champion isn't just any company paying a dividend. It's one that has increased that payout every single year for at least 25 years straight.
25 years?
Exactly. And then you have the really elite ones, the Dividend Kings. They hit 50 years of increases. It's incredible financial resilience.
It really is. So our mission today, uncover the secrets, behind that resilience, that reliability. We've got a fantastic set of sources for this deep dive, including a recent article looking at 7 top examples. We'll explore their strengths, their business models, and crucially, why this consistent growth actually matters to you.
Right. The big question is, what is it fundamentally that lets a company not just pay, but consistently grow its dividend for, well, a quarter century or even longer? We'll look at some real-world examples from the sources to, pin down those underlying principles.
Okay, let's unpack it. And it's interesting, isn't it, how many of these first examples are in, like energy and utility?
It does highlight something, yeah, that predictable, often infrastructure-heavy nature.
Definitely. So we're diving into 7 specific companies, starting with a real giant in the energy sector. First up, Chevron, ticker CVX, a leading integrated oil and gas producer. And get this, 38 consecutive years of dividend increases.
38 years.
Yeah. Think about navigating all those oil market downturns. Pretty volatile stuff.
Oh, yeah.
And still managing to raise a payout.
Well, and a core reason they can do that, something that really stands out about Chevron, is their upstream break-even level. It's industry-leading. Our sources say it's remarkably low, around $30 a barrel.
Wow, $30.
Yeah. So basically, this financial discipline means they can stay profitable, keep generating cash, even when oil prices dip quite a bit. That's a massive advantage in a cyclical industry like oil and gas.
That low break-even is incredible. And the sources also talk about a fortress-like balance sheet and one of the lowest leverage ratios in the sector. What does that actually mean, practically speaking, for maintaining those increases?
Well, it's not just jargon. It means Chevron has serious financial muscle, that fortress-like balance sheet. It implies lots of cash, low debt. It gives them flexibility. They can weather storms, jump on opportunities like mergers, and crucially for our discussion, reliably fund dividends even when things get tough.
Right.
And the low leverage just confirms they aren't stretched thin with debt. It's about stability.
Makes sense. And it gets even more interesting. They're expecting an incremental $12.5 billion in annual free cash flow starting next year. Plus, that merger with Hess. It apparently extends their production and cash flow growth way out into the 2030s.
And that right there demonstrates a core principle for these champions.
Yeah.
It's not just about current strength. It's about having clear visibility into future cash flow, strategic growth planned out for the long term. That's how they can offer a solid yield, over 4%, with such confidence.
Okay, so from oil fields, let's pivot to reliable power. Consolidated Edison, or ED, the electric and gas utility for the New York City area, they just hit their 51st annual dividend increase this year. 51. A true dividend king.
51, yeah. And the longest streak for any utility in the S&P 500.
Amazing.
And this is like a textbook example of that stability you get from regulated utilities. Their cash flow is super steady. Why? Because demand for electricity and gas is consistent, right? And the rates are government regulated.
Predictable.
Exactly. It provides a really solid foundation for growing dividends, largely insulated from, the wider economy swings. It's almost like a government-backed annuity sometimes.
And they're not sitting still. Con Ed plans to invest a huge amount, $38 billion, just to maintain and grow its operations through the end of the decade.
That's a massive commitment.
It really is. Shows how investing back into that core infrastructure gives them the power, literally, to keep raising that dividend, which yields nearly 3.5%. Okay. Building on that infrastructure theme, let's look at another energy player, but a different part of the chain. Enterprise Products Partners, EPD. This one's a master limited partnership in MLP. They own essential midstream assets, pipelines, processing plants, export terminals, and they've increased their distribution for 27 years straight.
Right. And for listeners maybe less familiar, an MMP structure is often used in energy. It lets them pass income directly to investors, usually avoiding corporate taxes,
Okay.
which can help with that attractive distribution yield nearly 7% for enterprise. But the key to their predictable cash flow, it's those long-term contracts and the regulated rates for using their assets. I mean, those pipelines and plants are critical for moving energy around. It makes their income incredibly stable.
And they're investing, too. They've got $6 billion in projects set to boost cash flow by 2026 and another, $2.2 to $2.5 billion planned for next year. Plus, one of the best balance sheets in their sector. Seems like plenty of fuel for more growth, right? Not just holding steady.
Absolutely. It's having that strong capital structure that lets you support not just what you have, but also build new things that lock in even more revenue down the road.
Right. Sticking with energy infrastructure. Let's turn to Enbridge, ENB. Big North American energy infrastructure company. They've raised their dividend for 30 years straight, and the yield is nearly 6%.
What's really striking about Enbridge, I think, is the extreme visibility they have into their earnings. Get this, 98% of their earnings come from predictable sources like long-term contracts. 98%.
That's almost everything.
Pretty much. And they've actually met their annual financial guidance for 19 straight years. That just underlines how predictability isn't just a goal for them. It's like built into their operational DNA. It's key.
19 years hitting guidance. Wow. And they're backed by some serious capital projects, too, about $32 billion or $23 billion US dollars through 2029. They expect cash flow per share to grow, 3% annually through 2026, then around 5% after that.
And that forward-looking plan is just critical. You know, it's not enough to just be stable. To be a dividend champion, you need that clear path to growing the business, expanding earnings. Enbridge clearly lays that out.
Okay, so from all that vital infrastructure, let's pivot again to something maybe less obvious but still essential, genuine parts, GPC. They supply automotive and industrial replacement parts, and this one, it's a Dividend King, having raised its payout for the 69th straight year.
69 years.
69! I mean, that's longer than some entire industries have even been around.
Just think about that. 69 years. The number of recessions, market crashes, global shifts that they've navigated while still increasing payouts to shareholders, it's incredible. And that longevity really stems from their resilience, right? They grew sales in 91 of their 97 years, increased earnings in 79 of them.
That's consistency.
It really is. And it makes you ask, what lets a business do that for so long? I think fundamentally it's about filling a need that just doesn't go away. Parts wear out, stuff needs fixing. It's evergreen demand.
I totally agree. They benefit from that durable demand, plus they have this really disciplined record of smart acquisitions that boost sales, margins, earnings. Their strong cash flow and balance sheet just power it all. Shows how smart expansion and financial health support that kind of longevity.
Okay, now for something completely different. Real estate. Enbridge. They're a REIT, a real estate investment trust, focused on single-tenant retail properties with net leases. They've increased their dividend for 36 straight years. That's the third longest streak in the REIT sector. Apparently, less than 80 public companies overall have hit that mark.
And the real genius here, the key to their stable rent income, is those NN leases triple net.
Triple net.
Yeah, it basically means the tenants cover all the property operating costs.
Right.
Maintenance, taxes, insurance, the works.
Okay. Hands off for the REIT then. Pretty much. It significantly cuts down NNN's overhead and, financial risk, makes their income streams super predictable. Plus, they're smart about investing in good locations, which makes it easier to find new tenants if they need to.
It really shows how specialized, well-managed real estate can be a dividend machine. And they've got a very conservative financial profile, giving them flexibility to keep buying more income-producing properties. That supports their dividend yield, which is over 5.5%. All right, finally, let's round this out with a global powerhouse most of us probably interact with almost daily, PepsiCo. Global drinks and snacks giant. Another Dividend King raised its dividend for 53 years in a row. Incredible.
53 years.
Yeah, we all know PepsiCo, right? It's amazing to think every time you grab a Lay's or a Pepsi, you're like chipping into a company rewarding shareholders for over half a century.
Well, the foundation there is just that incredible portfolio of iconic brands. They aren't just products, they're household staples. People buy them consistently, which generates that really steady growing cash flow that supports the dividend, which yields nearly 4%. It's a powerful economic moat, really, built on brand loyalty.
And they're not just coasting on old favorites, are they? PepsiCo invests a lot in new products, expanding capacity, getting more efficient.
Actively innovating.
Yeah. They expect mid-single-digit revenue growth, high single-digit earnings growth long term. And they're using their strong balance sheet for acquisitions, too, trying to shift towards healthier options. Shows real adaptability, even for a giant.
Precisely. It's that mix, right? Defending the core business while also evolving strategically.
So, pulling it all together, what does this all really mean for you, the listener?
Well, zooming out, looking across all these examples, there's a really powerful theme, isn't there? These companies aren't just lucky. They thrive because they're built on highly predictable cash flows, whether it's essential services, long-term contracts, must-have products, or those super strong consumer brands. What truly connects them are these incredibly strong economic moats, those competitive advantages that protect their profits over the long haul.
That's such a crucial point, the moat concept. For Chevron and Enbridge, it's maybe their sheer scale and control of vital infrastructure.
Right. Hard to replicate.
For Con Ed, it's the regulatory environment. You can't just start up a rival utility easily. PepsiCo has that immense brand loyalty. Genuine Parts has those distribution networks and the constant need for repairs.
Exactly.
These aren't just companies making money. They make it in ways that are really well defended against competitors, market shifts, recessions. That seems to be the real secret sauce for a dividend champion.
And that really brings up an important point for you, the listener. If you're looking for durable, steadily growing passive income from dividends, these types of companies are, well, pretty ideal candidates. Their whole business model is geared towards consistency, towards financial strength over decades. It shows that long-term success isn't always about those dramatic overnight growth stories.
Right.
Sometimes it's about disciplined, reliable performance that just quietly builds wealth year after year.
Well, that was a really fascinating deep dive into the world of dividend champions and kings. We've seen examples from all sorts of sectors: energy, utilities, consumer goods, real estate, all achieving decades of consistent dividend growth through really robust business models and smart planning.
Indeed. We've explored how that ability, that track record of increasing dividends for 25, even 50 years, it's such a powerful signal. It signals underlying financial strength, strong competitive advantages, those moats, and just a real commitment to returning value to shareholders. These examples really highlight the value of stability and resilience, especially in today's world.
So as you think about everything we've unpacked today, here's maybe a final thought to chew on. These companies have all raised dividends for at least a quarter century. As you look at other companies out there, what signs might you look for? What clues might indicate they're building that same kind of resilience, that consistent value creation that defines these champions? What fundamental qualities do you think allow for that kind of incredible long-term consistency in any business, no matter the industry? What economic moats are they digging? Thanks for joining us on the Deep Dive. We hope this gave you a shortcut to being well-informed and maybe sparked a few new questions for you to explore on your own.